Single entry versus double entry accounting. This is pretty straightforward. Single entry bookkeeping records transactions as you pay bills and make deposits into your company account. This works only if you're a small company with a low volume of transactions. So if you just started, then you may not, you don't have a lot of transactions, so you could keep track of them manually, and then you could give that to your accountant or your bookkeeper, and you're done. And maybe you don't need software. Now, this is not recommended because we hope that you can have enough transactions to have a nice lifestyle business. We're talking about somewhere about $75,000 a year. That may account to hundreds of transactions. And if you use the single entry bookkeeping system, that's gonna be a nightmare pretty soon. So there is a solution that most businesses use. It's called the double entry bookkeeping system, which means two entries at least are made for each transaction. For every debit, there is an equal and opposite credit. It's like a rule of physics. This is a rule of accounting. So, or a law of accounting. For every debit, there is an equal and opposite credit. So, single entry bookkeeping is simple but unreliable, and the other one is complex but reliable. Because it's a little bit more complex, that's why you hire a bookkeeper, just to make sure that your company ledger balances out. You have somebody that makes sure that every time there is money coming in, there's an account where you can debit it to make sure that everything balances out. Now I'm going to show you really quickly how I used to do it and how now I do it with double entry bookkeeping. So here's an example of single entry bookkeeping, how I started doing my bookkeeping at Grumo Media. And for every transaction, which was basically somebody paying me for a video, or I was paying a contractor for doing a video or a part of a video, then there is an entry. So, and they go under two columns, profit and loss. I make money, profit. I lose money or I pay somebody, loss. So you hear loss, 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 profit, profit, loss, loss. And I start at the beginning of the fiscal year, which for me is April 1st. Also, if there's any taxes, then the exchange rate, because I usually charge in US or Canadian. And then, boom, what was the method of payment, if there was any notes, the transaction number, blah, blah, blah. And then there's basically a balance. This is the balance of all the money, the profit and loss. And if it's red, is that at that moment I had a loss. And if I was doing better, then there was a profit in black. So this is great. This gives me a quick idea of whether at that specific moment in time for that fiscal year, I had a profit or a loss. Now the only problem with this is that I may make a mistake. I may enter the wrong amount from an invoice, and then how do I know if it was wrong or not? Because I don't have anything to reference to. And the way you reference to is because anytime money comes in or out of your company, that's going to be reflected on your bank accounts. So what you do with double entry accounting is that, okay, you may enter this as a profit, but then somewhere it has to be reflected on a bank account, a bank statement, that same amount. If they don't match, what happens? You made a mistake. So that's the beauty of double entry accounting, is that it avoids the possibility of mistakes happening because things have to balance perfectly. And the sample of here of double entry bookkeeping with QuickBooks, you can actually, if you have QuickBooks, you can go to reports and then go to the journal report, and you can select any specific time during your company, and we'll show you. For example, this was an invoice by this company, and the debit was from accounts receivable, was 25,000, whatever that specific number, and the credit is exactly that. And they always match, the debit and the credit from accounts receivable to sales or animations, it always matches. Now, because this is time consuming to enter, what I do is I give my bookkeeper my bank statements and all the invoices, and then they match them up. They enter everything, they make sure that it matches, and eventually what you get is that these two numbers right here, these two numbers, crucial numbers right here, have to be identical. Because they're identical, we know everything balances out we know that the likelihood of an error, an entry error from existing is very low. And this is crucial because you don't want to make any mistakes. If you make many mistakes, you know what happens? You may get audited. If you get audited, that's bad news. It won't be really bad news if everything, if they're not very big mistakes, but still it is a pain in the butt to be audited. So make sure that you hire a competent bookkeeper that can use QuickBooks or any other software to do proper double entry bookkeeping. Hey, did you enjoy this video? If you want to see more like this, just subscribe here. If you want a free gift, click here. Yeah. Which one is going to be the one you click? La 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 li 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 li. Oh.